Okay, let's just jump right in. We are currently witnessing what is arguably the largest coordinated technology build-out in human history. The stakes? Absolutely massive. Today, in this explainer, we're going to map out the $500 billion AI race. We'll look at exactly who is driving it, how on earth they're paying for it, and, most importantly, who is actually positioned to walk away with the ultimate prize.
To really grasp the sheer scale of what we're looking at, you've got to wrap your head around this staggeringly huge baseline number. $500 billion. That is the combined capital expenditure for AI infrastructure planned by just 4 companies over the next couple of years. This isn't some safe defensive hedge. No way. This is a multi-billion-dollar offensive strike, and it's all built on this one core belief that AI compute is going to be the single most scarce and valuable resource of the next decade.
And the wild part? Everyone is completely doubling down. When you look at these year-over-year changes, we're talking about a 77% jump overall from 2025. You've got Amazon and Microsoft both guiding towards basically doubling their spend to roughly $200 billion and $190 billion respectively. Alphabet is surging past $175 billion, and Meta is leaping up to potentially $135 billion. Analysts are already projecting that the combined hyperscaler capex could top $1 trillion by 2027. I mean, it is an absolute frenzy right now.
But what are they actually spending all this cash on? It's really easy to picture them just, adding massive orders of NVIDIA chips to a digital shopping cart, but the reality on the ground is so much more complex. Sure, NVIDIA H100 and GPU 200 GPUs make up almost half the spend, but they are also building massive physical infrastructure. We're talking about 18 to 24-month lead times just to construct these highly specialized data centers. They're completely redesigning cooling systems because of mandates for directed-chip liquid cooling, and they are putting immense, literal stress on the power grid. Plus, they're pouring billions into their own custom silicon, like Google's TPUs and Amazon's Trainium, so they can eventually reduce their reliance on NVIDIA.
Section 1. Strategies of the Giants. How they plan to win.
So, when we look at how they actually plan to win this thing, a really sharp divide starts to emerge. On one hand, you have the platform player, think Microsoft. They have a very direct business-to-business monetization strategy. They're making immediate money today by selling the picks and shovels to enterprises through Azure AI and Copilot subscriptions. But then on the flip side, you have the integrator, like Meta. Meta basically has zero direct AI revenue. Instead, they're playing a much longer game. They rely entirely on indirect consumer-facing monetization. They're literally giving away their massive open-source Llama models to build up an ecosystem with the ultimate hope that all this intelligence translates into better user engagement and much sharper ad targeting. Section 2. The hidden debt problem. Funding the AI build-out. Now this brings us to a huge seismic shift happening in Silicon Valley. Historically, these tech titans funded their own expansion just using the massive cash generated from their core businesses. But building physical infrastructure of this magnitude, that requires an entirely different playbook. Companies are now transitioning away from self-funded expansion. Instead, they're leaning heavily into a sustained reliance on global credit markets and securitization. Balance sheet capacity is quickly becoming a massive bottleneck across the entire AI ecosystem. And the scale of this borrowing is truly historic. In 2025 alone, public tech investment-grade bond issuance blew right past the $200 billion mark. Think about that. The AI and tech sectors have completely dominated the global credit supply, becoming the absolute largest new source of corporate debt. Just look at Meta as a prime example. Back in October 2025, they priced a $30 billion investment-grade financing. That is among the largest corporate bond financings on record, because while revolutions aren't just sustained by fancy model benchmarks and computing power, right? They are sustained by cold, hard cash flow. And right now, the central tension in the entire ecosystem is that innovation is simply moving faster than financing capacity. The durability of this whole AI movement completely depends on translating this massive disruption into actual balance sheet strength.
Section 3. The $1 trillion gap. Revenue reality check. When looking at that reality check, the folks over at Apollo Global Management actually ran the math. The market expects a total of $4 to $5 trillion in digital infrastructure investment by 2030. Now, to justify that kind of eye-watering spend and actually deliver an acceptable return, AI end-user revenue has to absolutely explode. We're talking about needing $1.5 to $2 trillion in annual revenue by 2030. Compare that to the estimated $35 to $65 billion generated by new AI applications in 2025, and you can see this massive gaping chasm they need to cross.
Just to put that $2 trillion target into perspective,
AI has to generate as much new money as the entire global enterprise software industry and the global online advertising industry combined. It's not mathematically impossible for sure, especially if AI successfully automates even just a fraction of the $60 trillion global knowledge workforce. But still, it is a tremendously steep hill to climb in just a few short years.
Section 4. The Infrastructure Trap. Lessons from History.
This brings up a really chilling historical parallel pointed out by NYU valuation professor Aswath Damodaran. Look back at the dot-com boom. Cisco Systems built the actual plumbing of the early internet. Their stock went completely vertical, peaking in March of 2000. But here's the catch. The infrastructure kings who build the pipes rarely capture the ultimate compounding wealth of a tech revolution. Today, Cisco trades way below that peak. Meanwhile, Amazon, a company that basically just used those pipes to sell books, is worth over $2 trillion.
History shows us over and over that technology cycles follow a remarkably consistent pattern. Act 1 is always the infrastructure boom. Companies like NVIDIA capture the first wave of investor enthusiasm with extraordinary revenue growth. But eventually, competition enters the chat, and the foundational technology commoditizes. We're already seeing this happen, with a swarm of custom silicon chips from AMD, Google, and Amazon all racing to erode NVIDIA's pricing power. Then comes Act 3, the application coronation. This is where an application company inherits the revolution, rides the now cheap infrastructure, and compounds massive value for decades through consumer network effects.
Section 5. Who will actually win? The ultimate prize. So, the most fascinating takeaway from this explainer is understanding this fundamental wealth transfer. The billions of dollars pouring into big tech today, all those massive capex budgets and bond issuances we talked about, are effectively subsidizing the digital infrastructure of tomorrow. This infrastructure will eventually be used at dirt-cheap commoditized prices by the ultimate late-cycle application winners. Think about it. The infrastructure investor pays for the revolution, but the application investor inherits it.
So we're going to leave you with this final thought. The ultimate victor of this $500 billion AI race might be a company that doesn't even exist yet. It could literally be a startup right now with fewer than 50 employees, just patiently waiting for computing costs to plummet. When the chips are commodities and the massive data centers are already built, who is going to build the application that a billion people simply cannot live without? Because that is where the real trillions will be made. Thanks for joining me on this explainer, and definitely keep your eyes on who starts building on top of all